Okay, so I'm with our CEO, Dr. James Moria, who will be taking us through the performance of the company. And my name is Wambua Kimeu, the CFO. I will be taking us through the financial performance later on in the briefing. So let me welcome Dr. Moria to kick us off.
Thank you very much, Wambua. Good morning, ladies and gentlemen. It's a pleasure to welcome you to the Centum Investor Briefing for the year ended March 2021, which I'll be doing with my colleague, Tino Wambua, who is our Chief Financial Officer.
Okay.
So we start off with the business review, just sort of a recap of what our business model is. So our business model really is to deploy capital into companies, create and grow value, and ultimately monetize that value through exits. So primarily the bulk of our return comes from exits, but before we exit, we generate income from dividends, fees, and other streams. That's really what we're all about, and that is particularly for anything other than what is in our marketable securities portfolio. As part of our Centum 4.0, we made a decision to de-risk the business and the way we invest, and have a core portfolio which is a high income yielding portfolio, which is relatively low risk. So that would then generate a consistent income stream, and that income stream is what would then be distributed to shareholders as dividends, and the balance would be available for investment. So for those of you being with the company for a while, you recall in previous years we were investing borrowed capital. But as we build up the capital base of the company, we are now looking to invest income into the risky segments of the portfolio, which is private equity ventures, and grow those and exit. And it was against this context that we had a number of strategic objectives. The first one was to deleverage the portfolio. And the reason we wanted to deleverage the balance sheet was to increase the net cash income of the business. The net cash income is the difference between the income we're generating, the operating costs, and the finance costs. And when we started Centum 4.0, which was at the beginning of 2019, April 2019, the balance sheet had a debt of 16 billion shillings. The objective was to fully retire the debt within the current strategy period, which ends in 2024. As at 31st March 2021, we had retired 13 billion of the 16 billion of debt, long-term debt, and we are at 81% achievement of that objective. We also had an objective to increase our high-yielding portfolio, which is largely a cash income portfolio, by 10 billion to 10 billion by 2024. As at 31st March 2021, we were at 7.5 billion, so we're 75% on target. On portfolio returns, as I mentioned earlier, the objective is to make investments, enhance value, get capital back, and ultimately exit the investments. Last year was a milestone year for us because we completed the reorganization of our real estate holdings and consolidated them under a company called Centum Real Estate, which is a company that has now issued a listed bond that is listed on the Nairobi Stock Exchange, and their CEO made a presentation recently. Last year was the first year that we got money back from that particular company, and we received 4.5 billion shillings, which is made up of both interest and return of shareholder loans. So that is approximately 60% of the total capital deployed in that business. That's what we received last year. In the year ended 2021, we did not make any exits. That is largely because the economic environment was not favorable for exits. We've been having a very active portfolio management within our private equity portfolio, both to help the business weather the storms that were created by the COVID-19 situation, but also set them up for recovery, and we'll be discussing how they're doing. The core idea here is to enhance return to Centum shareholders. In the last 2 years, we've paid 1.6 billion of cash dividend. We'll be discussing what dividend we're declaring this year, and also to preserve capital. As I mentioned on real estate, the key highlights, Centum Real Estate, a I'll be discussing this later. The objective was to move from vacant land, which is where we started, the risk, build value, and eventually end up with an investment grade asset that we could exit. I think we are on the tail end of achieving that. Last year we completed the reorganization. As I've explained, we had a significant capital return. Centum Real Estate secured an investment grade credit rating and issued a bond. And it has a significant pipeline which is set to, has about 4.5 billion, which is going to be distributable to the major shareholder, to the only shareholder, which is CACP, about 4.5 billion, and a further 2 billion worth of development rights that have been sold, which are in the process of completing, and there we expect to get a further distribution of 1 billion. So based on the pipeline of this particular company, there's a potential distribution of up to 5.5 billion over the next 36 months. Private equity, the focus of last year was to ensure the company survived the COVID-19 pandemic and that they were set up for recovery. 5 out of the 9 companies remained profitable in the financial year ended 2021. We've been building up our high yield portfolio. It's now at 7.5 billion. 93% of it is allocated to fixed income and cash for capital preservation. We are currently at 12% return. We've been enhancing it as we've been shifting from lower yield assets to higher yield assets. So the target is to get this to around 14%. Now, the most important statement for us as an investment company is our total return statement, which mirrors our company P&L. Investment income came down to 1.5 billion, and that is largely because of 2 reasons. One, a number of portfolio companies did not declare dividends because they were conserving cash for their own requirements. And secondly, we did not have any exits in this particular year. In the year ended 2020, we had about 2 billion of that was from exits. We had a number of cost containment measures in the year, which reduced operating expenses by 25%. We also on track as a result of the reduction in the debt of the company. The finance cost reduced by 67%. Now, in aggregate, the operating profit, which is really the cash profit, was at 245 million. We had a revaluation of our assets in light of the environment that we're in, and we passed impairments of 1 billion through the P&L. The impairments that passed through the P&L is where we've not had any previous revaluation, so it was carrying those particular assets at cost. And that is what explains the profit after tax, a loss of 600 million. We had further revaluations of other investments where we had previous revaluations, and those go through what is known as other comprehensive income in the P&L, but these are unrealized losses. This is where we've had previous revaluation gains. Now, the primary reasons for these revaluation losses is because last year we witnessed a decline in the markets, and we revalue our portfolio based on multiples, market multiples. So market multiples came down, and so did the profitability of a number of the underlying companies. As a result, we had a revaluation loss of the underlying portfolio of 4.2 billion. So in aggregate, the total return was 4.8. As a percentage of opening NAV, it was 10%, negative 10%. That shows you the NAV movement from 47 billion, 41.8 billion. On the last segment here, part of it was capital that we have returned to shareholders in the year. So last year we paid a dividend of 800 million shillings, so that accounts for that decline. We have unrealized losses of 4.2 billion. Actually, if you take the 4.2 and the 1 billion, because they're both unrealized, you have unrealized, which are really revaluation movements of 1 billion shillings in light of the environment that we had. That slide sets out the NAV attribution. So our private equity business, the NAV per share is about 11 shillings and 60 cents. Centum Real Estate, which is our portfolio company now. Before last year, we had this in different components. We had all the constituent businesses, sort of big individual businesses, but today we have one company. That's about 30 shillings, and then have a discussion about that. TRBL was not part of Centum Real That's the evolution of our share price. It's not done well. The market has also not done well. What we focused on doing is preserving NAV per share in the last 2 years when the markets have been battered. The primary reason why NAV has come down is because of the revaluation movements, which tend to mirror the market because you have to revalue based on market multiples. And so we've passed a significant quantum of revaluation losses through the P&L. The second reason is the dividends that have been paid then tend to also to reduce the NAV per share. That slide breaks down sort of the share price, that's 17 shillings, into what is a market cash and high yield, that's about 11.3. Because one of the feedback we get from analysts is the difficulty in valuing the business. And so what you're trying to do is sort of give a simplification of how it looks like. So if you take our price of 17.3 and you see that there's cash and there's a liquid portfolio of 11 shillings and 30 cents per share, then the difference is 6 shillings. The rest of the portfolio is valued at 6 shillings per share. That portfolio is made up of a private equity portfolio of 11 shillings per share, the real estate portfolio of about 30 shillings per share. So the combination of the two is about 42 shillings per share. When you add TRDL to it, it's about 51 shillings per share. So that is what is valued. We have an underlying asset value of about 52 shillings. At the market today is trading at about 6 shillings. So it's a significant discount to what the market is to what the value is in the market. Over the last 10 years, what we've really been doing is building up value on our balance sheet. If you recall, we started off with sort of at 6 billion shillings in 2009, and we've not had any equity raise in the period, and we've had distributions of about 3.8 billion shillings to be precise. So we've been building this value organically by investing in business, growing value, exiting, and recycling capital back into the business while having some distribution. So today NAV has moved from 12 billion to 41 billion as at 2021. So that's over a 10-year period. That's our cash flow. For the year, we had a cash flow from operations 4.5 billion, financing activities 4.5 billion, and that was primarily the net cash flows arising out of the repayment of the bond that we did within this financial year in the third quarter of last year. So let's move to the portfolio review. I'll start off with Centum Real Estate. Just a recap of what the objective was, because this has taken time. We went back to the annual report of 2010-2011 when we made the first investment in real estate. And as you can see in the report, the objective was to move from high-risk bare land, plan it, execute, and then end up with an investment-grade asset that could be exited. And along that path, reduce risk. And that's exactly what we've been doing over the last 10 years. We've ended up now with a relatively good quality investment-grade real estate asset with an investment-grade credit rating, all the way from starting off with bare land, and that is cash generative. We've cumulatively invested 7.8 billion in this business. So far, we've had returns of 4.5 billion. We are carrying this business at 22 billion on our balance sheet, and the potential distributable profits just from the pipeline that the business has at the moment is 6.1 billion shillings, which is not part and parcel of the valuation of 22 billion because it's not yet realized. And that's what we've explained here. So we've been on this journey, and I thought it's important just to recap what the journey is. And if you tie it back to the earlier slide we had, the idea for us is to always sort of move up the path, create platform companies that we can exit at a reasonable valuation. And Centum is no different from any other portfolio company we have. It is sort of on that journey, and we are pleased with the progress that we've made. It now has an independent independent board, an independent management team, and it's running as an independent portfolio company. So that chart shows what are the components within Centum Real Estate, and separately we have TRDL, where we have other investors with us. TRDL, the business model of TRDL, where we own 58%, is sale of development rights to third-party developers. And the idea of development rights is to bundle, not just to sell the land, but to bundle the land, the infrastructure, the regulatory approvals, the location, and avail that to developers. And that gives developers a number of advantages. One, it gives them a cost advantage, because the selling price of development rights at, say, a location like Two Rivers, or even Bipingo and Palmarina, is lower than if you have to go to a greenfield site and buy land and then put all the infrastructure in place. So one, there's a cost advantage. Two, there's a time advantage, because all the approvals are in place and the developer does not have to spend time sort of securing approvals, and also developing the enabling infrastructure. So that's the second advantage. The third one is a risk advantage, particularly from a regulatory risk perspective. The fourth one is just ability to sell faster because of the branding of the destination. And we have seen that validated very well in terms of the developments that Santa Maria has done at Two Rivers, for example, whether it is Cascadia, Loft, Riverbank, Mzizi, they have sold very well. We've seen the same in Bipingo, where we're almost 100% sales, and we've seen the same in Palmarina. So one wants to be that location, and we are seeing very good traction in terms of sale of development rights. In fact, across the Centum Real portfolio, at the moment they have sales in progress of about 2 billion shillings across the group, and a lot more in the pipeline. So we are seeing a recovery from that front. The other thing is that TRBL is also developing its own units. So we've developed Mzizi, which is an affordable housing scheme, and that has sold 116 units to date and mobilized 140 million in deposits since it launched. The challenge that TRBL has, and Wambua will be explaining in his consolidated financial performance, is a capital structure, where we have debt both at TRLC, which is a mall, and at TRBL, and that debt has a heavy finance cost component, which in a year when you've not had sales, then passes through the P&L, and because it's a subsidiary of Centum, we end up consolidating 100% of the performance of TRBL, even though we only own 58%. So what the shareholders of TRBL have resolved to do is to raise equity within TRBL so as to pay off the debt, so that when that completes, we will be diluted possibly to below subsidiary level, but then we have the savings arising out of the interest. So the idea is for TRBL to be a pure equity-funded business, and we made very good progress with a number of investors in this particular regard, and we hope to conclude this capital raising within this particular financial year. That is within TRBL. The same exercise is taking place within TRLC, because when the mall give tenants discounts, what then tends to happen is that the rental then comes, it's not sort of fully covering the finance costs, and so there's a debt to equity conversion taking place at TRLC, which will see the interest component of the debt within TRLC come down. Actually, a debt to quasi-equity sort of conversation taking place at that particular level. So the bulk of the number you will see in our financial statements is arising out of that particular situation in TRBL. But the management of TRBL, Centamri, who the board of TRBL has appointed as a development manager, is working hard to resolve the capital structure issue in TRBL. The private equity business, the focus of this business is to drive value through enhancement of profitability and ultimately to exit the underlying portfolio companies. We had a number of exits that we had lined up in 2019. In fact, they've signed some term sheets and we're in advanced stages. However, COVID put paid to some of those plans because of the adverse impact it had on the portfolio companies. And so the portfolio management approached to sort of stabilizing the business and now working towards recovery. And we have seen good recovery in a number of the companies over the last couple of months, and I'll be speaking a bit to that. An example is Syria, where last year, the whole of last year, we had a profit of only 19 million shillings, a profit of 19 million shillings. In the first quarter, to March 2021, the profit was 102 million shillings. In fact, it is even higher than what it was for the full year in 2019, just Q1 alone. And we've seen that momentum increasing even in Q2 to June. I would have shared the numbers, but CDN has not yet announced the numbers, so I can't share the numbers to June. But we've seen significant momentum, so there's been good recovery. There's also been significant improvement in the quality of the loan book. So NPLs have come down from 20% to 11%, and significant improvement in liquidity in the business. Longon is another of our portfolio companies which was hard hit, largely because schools closed. And with the long period that schools closed, orders came down. And the challenging thing with COVID-19, although CDN is very geographically diversified, COVID-19 sort of affected all markets. So we had closure of schools in all markets. And the primary focus of Longon is selling educational books. We've seen a recovery last year, in the year June 2021. The results that will be announced by Longon, which is a listed company, shortly. But we've even seen a further recovery this particular financial year, the orders that are coming through. So we expect for Longon in this financial year ended June 2021, they will book a profit and will be back to significant profitability in the subsequent year, assuming we don't have any further prolonged lockdowns. Isuzu East Africa has continued to do well. Market shares continue to improve in the period, going up 20%. And just last week we celebrated the production of the 100,000 vehicle, and it's a demonstration of the growth that has been achieved. In fact, the challenge Isuzu has had is capacity constraints to fulfill the orders, largely due to supply chain constraints that have arisen as a result of the pandemic. If we did not have those constraints, the sales would have been significantly higher. NAS Servair, unfortunately, is one of our portfolio companies that was previously doing very well, a good dividend earner, but which has been adversely affected by COVID-19. It's still sort of working to recover, and that's because the aviation industry has not fully recovered. We still have significant constraints around international travel. Different countries have different lockdowns, and we keep on. So until we see a recovery in the aviation industry, I think it will take quite some time for sort of NAS to come back to where it was. But it's holding its own in the interview. Greenblade Growers is an interesting case. This is our agricultural business that we started as a greenfield venture. We had a lot of challenges last year when the markets were locked down, but we had also good recovery in the year, and that just shows you month-on-month profitability. So by March of 2021, it was making a PAT of about 13 million a month. And these are businesses that can be very substantial. The constraint again being largely on the supply side rather than on the demand side. So we see huge potential to scale up the business to sort of a $2 million EBITDA business in the short run. And there are significant synergies between Greenblade and Centum in terms of Greenblade being the agricultural partner for Centum in terms of the unutilized land that Centum holds across the various markets, and that's what we're using this company for, those kind of synergies. So for us, it's an exciting venture. We've seen good recovery, and we think we're working on sustaining it. Aklira Geothermal, this took us time. We recall last time I mentioned that we were working on geoscientific studies to resume drilling. We've then been engaged with strategic partners who have drilling expertise to work on the main development of the resource so that we can do a drilling cost for equity swap to reduce the cash component of the drilling. We finalized agreement with a particular strategic partner, and we're hoping to resume drilling this year. This is an important source of power. It is base load power, and it is green energy. The PPAs and all the other agreements remain in place. So it's taken time, but I think this is the nature of geothermal energy. Marketable securities is a key component of our portfolio because it's part of our strategy of de-risking the business, where you build this up, generate a consistent annuity income. That will also give our shareholders a consistent dividend stream, and we then invest the income arising from this particular portfolio. So we've been building it up over the last 2 years. So from about less than 2 billion shillings, it's now come to 7.5 billion. The target is to add it up to around 10 billion. And we'll continue to do that even as we pursue other investment opportunities. I want to speak about just the investment environment on the PE front. We've looked at many opportunities, but because of the uncertainties on the external environment, we're quite cautious about making new investments in this period. Really, we make our value through growth, and the environment has been quite constraining, and there have been a lot of risks, and so one is not certain how long that growth will take and whether the valuations can be sustained. So we've been a bit conservative in terms of new deployments, but as we monitor the environment, we'll be possibly looking at new opportunities in the coming year. Across the portfolio, there's been reasonable recovery. I forgot to mention that even at Centum, we've seen recovery from collections, because what tells us how the business is doing is collections. In the year ended March 2021, the cumulative collections the year was about 1.8 million shillings. It had declined very significantly in April and May of 2020 when we had the lockdowns to June, and these lockdowns were both in Kenya and Uganda. However, we encouraged that just in the first quarter alone of this year, April, May, June, they collected just shy of 1 billion shillings, so 60% of what they did in the whole of last year, and we've seen that momentum sustained in July and in August. So hopefully with the recovery, you'll see increased investment activity and faster momentum in the execution of the business model. We had a number of CSR engagements which we continue to do and to support various portfolio companies. So in the Pingo, we've done a lot of work around scholarships, so 200 scholarships awarded to date. We've set up a vocational training center. We're just selecting one that is in Kilifi County, where we equip the local community with relevant skills, so that then they can form the bulk of the labor force in the various projects. Last year we won Fire Award in terms of the winner in the integrated reporting category, and we continue to enhance the disclosure that we make in our financial reports. So I'll hand over to my colleague Aklira Geothermal to take you through the financial performance. Thank you very much.
So thank you, James. So I'll take us through the financial performance, and as James has highlighted earlier, our key focus really is on the company income statement. And I think it's important for us to recognize that we are more of an investment company. We develop assets, we own assets, our target is to grow them and thereafter to dispose them off at a gain. So really we are an investment company, and our key focus will always be on the company income statement, which is what James mentioned earlier, our total return statement. So James already covered quite a bit here in terms of the performance of the year. When we look at in terms of how the performance was, just the exceptions. So last year we had the gain on the sale of the bottlers, which this year we didn't have any exit. Our investment income therefore came down, but I think it's also important to recognize that our investment income is the income we are earning from our high yield portfolio has actually gone, is actually quite high, close to 604 million shillings. And we are also earning, as James mentioned earlier, we've received money back from the Centum real estate portfolio company. And that is what is actually forming quite a part of our investment income this year, and a bit of dividends. On the operating expenses, our target is to have our operating expenses at close to 30% or below of our investment income. Significant gains have been made around that. We've come down from 895 to about 670, and we'll still keep working around our cost management. So as we move forward, our aim is very simple. Investment income, pay down your operating expenses. As James mentioned, our target is to have zero debt. Therefore, then what you end up with is an operating profit that's then distributable to your shareholders and for reinvestment in the portfolio. So when we look at our finance cost, this came down as well from 1.8 billion to 603 million, driven by the payment of debt. We paid almost 6.6 billion in the bond. And therefore, when you look at our operating profit, which is 245 million, is reasonable compared to the circumstance in which we are operating. And at 245, that's really what you'd almost call a cash profit for the business. In terms of provisions, so we took an impairment of almost 1 billion shillings. James earlier explained that this provision was really for the assets that we were carrying at cost, which we hadn't revalued previously. And here we are being prudent. I think one of the things that comes out is we are also quite prudent and conservative in terms of the valuations that we take through. And I think that's a reflection of when you look at the impairment provision we've done and then realized losses that we've booked, that we are just not, we are doing this in line with what the market has and also in terms of our conservative nature in terms of valuations. So the profit before tax, we have a loss of 826, an income tax expense of 220, mainly driven by deferred tax adjustment, and then our profit after tax of about a loss of about 606 million. So as we mentioned, the unrealized gains, losses, these were mainly driven by the revaluations downwards for our PE portfolio, and also the revaluation on part of our TRDL business, which we carry at book value, and then also from the real estate, as multiples have come down across all businesses. So here we have our balance sheet, statement of financial position. So this is for the company. James has covered quite a bit in terms of how we break it down on the various verticals. But I think for me, the key things that to highlight here is that one is that our balance sheet is very strong. Balance sheet is our total portfolio is at 46 billion. If you look at our equity position is at 41.8 billion compared to 47 billion last year. But I think for me, the key thing just to highlight about the strength of our balance sheet are a number of things. One is our retained earnings, still quite high, 19.8 billion shillings. Our revaluation reserves are at 21 billion. And I think the reason I'm highlighting this is that over time, as James has mentioned, we have been growing organically. And the organic growth that we've been experiencing in terms of just reinvesting within the business and the gains that we've gotten on disposals, all that is sitting in our retained earnings. And I think this is part of what is making the balance sheet strong. On the other hand, if you look at our asset side, we have about 7.5 billion in our high yield portfolio. And if you look at the portfolio that we currently have, actually, as James mentioned, cash and cash equivalents is about 90% of that 7.5 billion. So for us, I think in terms of cash available, we have quite some strength and headroom on our cash part. And then also just to highlight in terms of the returns that we're getting from this portfolio is reasonable. I think just to continue on the same thing around cash, James mentioned around that our cash flow from operating activities was about 4.5 billion. So the key driver here really is we received 4.5 billion from the real estate business. We also received the income from the marketable securities portfolio, and we ended up also paying for our finance costs and our operating expenses. So the 4.5 billion that you're seeing here is really net of making payments for our OPEX as well. In terms of what we've invested additionally in the year, so a total of about 2.1 billion. So additional investment in our subsidiaries and also purchase of government securities and corporate bonds. So I think on the financing side, we've mentioned earlier that we paid dividends. Close to 763 million is the cash outflow. In terms of what we paid for interest, almost 600 million, and we repaid down our borrowing. So at the end of the year, we had a net position between cash and our overdraft. So cash of about 867 million and an overdraft of about 1 billion shillings. So that brings us to the dividend based on the company performance. As I mentioned earlier, as we looked at the company income statement, we had an operating profit of about 245 million. And this is on the back of the impact of COVID that really impacted the company in terms of some of our portfolio companies didn't pay as dividends as expected. But I think the performance that we had was quite resilient. And on the back of that, the board has proposed a dividend of 218 million, lower than last year, but I think the 218 million is reasonable given the performance this year, and also just to cushion our shareholders in the current year. When you look at historically what we've paid over the last close to 6 years or so, we've paid about 4.1 billion in dividends. And this is consistent with the current strategy that we need to continuously just focus also in terms of payment of dividend and meeting our reinvestment needs and also holding on liquidity. So as I mentioned earlier, we are an investment company. So really our focus has been to look at our performance from the investment company perspective. Here we do our consolidated income statement, and the reason we do this is really driven more by the Companies Act, which requires that we prepare group accounts. This is something that IFRS allows for both the investment company or the consolidated approach. I think this is something that a lot of investment companies across the world also grapple with at times. So, but just to take us through in terms of the performance, this year what we've done is try and give a bit more color to the different facets of businesses that we have. So on the trading side, here we have mainly Longhorn, we've got Tribus, we've got a number of the trading businesses. Greenblade is here. So here the real impact, we performed a loss of 529. James highlighted that the key driver was really Longhorn, given the impact of the closure of schools last year. On the financial services businesses here, we mainly have CDN, we've got NABO there, and this performed very well if you compare with last year, 330 profit versus 171 million. Our real estate business, this also performed well, 875. Key thing here is that now we've started taking through in the performance of this business, they've started booking the sale of units as they hand over, and we also had just a little bit of, we also had sale of development rights during the year. The other one, which is really where I'd focus just a little bit on, was the performance of the Two Rivers Development Limited, which, as James mentioned, is composed of two businesses. There's Two Rivers itself, development, and then we've got its JV, which is Two Rivers Lifestyle Center. So if you look at their performance, 1.8 billion, the key driver are really two numbers there. One was the finance costs at Two Rivers, 1.8 billion. And that is what now James mentioned, that we are working towards reorganizing their capital structure so that then we can bring down this finance cost, which includes bringing in additional equity into the business. So this 1.8 billion is really 100% of that finance cost for this business, in as much as we own 58% of it. Our joint venture, which is Two Rivers Lifestyle Center, so our share of that loss was 1 billion, again driven by the finance costs, and we are taking again similar measures as TRDL, which is restructuring their balance sheet and their debt. Our investment income, as we mentioned, 684 million. So in total, when you look at our profit, our loss before tax of 2.3 billion, really you can see the driver there was Two Rivers and Longhorn, for which we've already highlighted what really we are working on this year to reverse that performance. When you look at the final comprehensive income, a loss of 1.4 billion, you can see even from how you attribute that loss. The amount that is attributable to Centum is only 706 million. And what is attributable to the minorities of all the other businesses is a loss of 749. And this is driven by the loss in, again, Longhorn for the minorities who are there, and also for Two Rivers development. And I think with that, you are able to see really the performance of the individual businesses. The consolidated financial position, this is just really summation of all the balance sheets for all the companies, and total of about 109 billion. To us, you're really adding up very different types of assets. You're adding up work in progress for the real estate, combining it with deposits that we are receiving and investments by the bank. So really, if you looked at the balance sheet, it really doesn't say much. But I think the key thing to highlight here is that this year we did a restatement of our balance sheet. This was driven by a restatement in the deferred tax number that was carried out by the real estate business. And this was because based on the increased activities in the real estate business, then the business has really, we've had to move from accounting for deferred tax from 5% to 30%. And given that they had to do that adjustment, then it also flows through into the consolidated financial position of the company. So thank you very much. And before I hand over to James to walk us through the outlook, we have a tab for questions. Kindly feel free to type in your questions there. We'll be very happy to answer them at the end of this session. So I'm looking forward to seeing your questions and us answering them. James, thank you.
Centum really, in future presentations, is not different from CDN, it's not different from Longhorn. And just like all the other assets we have, prepare the asset for exit as it approaches sort of maturity. It's a great platform company. And any strategic investor looking to make an entry into the region, it's a wonderful company with a team that is able to sell, with a pipeline, with governance, with controls, with sort of a very experienced team that can do a lot more. For various private equity companies, we are pursuing value creation opportunities driven by growth as we prepare them again to take them closer to exit. We're also looking for new opportunities in the private equity space. These are really companies that we can transform and whose performance we can improve. So customers with sort of a solid market presence, but where there is scope for us to enhance value, as opposed to sort of more mature companies. We're sort of more interested in that space where there is transformation opportunity. And the number of companies we're in discussions with, and hopefully we will close some new transactions in the coming financial year now that the economic conditions seem to be stabilizing. And the high yield portfolio, again, we are just focusing on capital preservation and providing consistent liquidity. So then what we invest in the more risky side of the business is the income as opposed to the capital, and working on generating market-beating returns on that particular business. Performance reporting, Wambua has a task now to more align the company reporting to the business model. The requirement to consolidate our performance and prepare group reports is very confusing to many people who look at our results. So just trying to figure it out, and that's why we need really to continue to emphasize that the focus should be on the company balance sheet, because our business is not complicated. We're just a simple investment company, invest in companies, create value, and exit. And the bulk of our return really comes from exits. if you look at the exits that we've done so far, we've done about 10 exits, realized about 32 billion shillings. But if you look at the dividend that was realized for those companies over 10 years was less than 3 billion shillings. So the growth, the path to exit is really how we create value in all companies. And the underlying activities are just activities that are geared towards enhancing the valuation of the business. So we are working to align more how we report to the market to what our core business is, so that we minimize that sort of understanding gap, and we all look at the business the same way. So we'll be including additional relevant KPIs for better information. So we are open for Q&A. Thank you very much, ladies and gentlemen, for your kind attention.
Okay. So thank you, James, for taking us through the outlook. So we are seeing a number of questions coming through. Maybe we'll kick off. I'll start off with the first one to James. The question comes from Tarang Patel, and his question is, has there been any progress on share buybacks in order to reduce the discount to NAV? James?
Thank you very much. The focus of the company is to distribute income rather than capital, and that's the way the current distribution policy is. The second thing is that in the last 2 years, because we had to make some priorities, we focused on the debt reduction. So if you look at the financing outflows we've had both in debt and dividends, about 17 billion shillings. And had we not made that decision, the balance sheet would really have been affected by what has happened with COVID-19. We also focused on enhancing our marketable securities portfolio, which increased by about 5 billion. So we've deployed about 22 billion into sort of those two endeavors. So I think as we increase the recurrent income, we'll then explore the issue of how best then to distribute that income, especially if we have sizable exits in the coming couple of months.
Okay. So thank you, James, for that. I think the other question is coming from Kelvin Maringa, and his question is why we decided to reduce the dividends, and if this will have a negative impact on the share price, considering that Centum has about 8 billion in liquid assets.
That's okay. Again, as I mentioned, Kelvin, the focus of the board and what we've communicated is that we don't want to distribute capital. We are distributing the income in the period. And as we've explained, the recurrent income in the period came down, largely because a number of companies that normally pay as a dividend did not pay the dividend last year. So we've taken the cash income that we made this year, net cash income that we made this year, and largely distributed it. I expect in the coming year that we should be able to improve the cash income, because some components of costs have come down. Finance costs have come down further. Last year we had larger finance costs because we held the bond for a portion of the year. Operating costs are expected to come down this year, and our cash income is going to improve this year because some of the companies have also resumed paying their dividends.
Okay. Thank you, James. The next question, I'll take this from Francis Mwangi, and his question is, which assets does the impairment provision relate to? So Francis, so the impairment provision, the one that we've taken directly through the income statement, is really related to the development, some of our development assets. And the reason we've done that is because we've been holding these assets at cost. One of them, as James has mentioned earlier, is we are in advanced discussions on Aklira, which just for prudence purposes, given what we are seeing in terms of the discussions and what we are seeing on valuation, then we took it prudent to make an adjustment or a provision for that. Thank you. The next question is in terms of, just a minute. So the next question again is on the dividend, and this comes from Sarah Wanga. Was there a change in your dividend policy? We expected you to maintain last year's dividend, and what is your new dividend policy?
Yeah, with the dividend policy, we had a long debate on this issue at the board audit committee. Yes, it's true we have a dividend policy, but the dividend policy also needs to take into consideration the context of the environment. We had a very challenging economic environment last year with COVID-19, which was not anticipated when we came up with the dividend policy. So the normal expectation that we should have paid the same dividend as we did last year. However, in light of the the circumstances that we had, the board thought that it's prudent to align the dividend payout to the actual cash income that has been made in the year. Hence the reason why the board has recommended a lower dividend this year.
Okay. So thank you for that, James. The other question comes from Peter Ndungu, and his question is, when should we expect the portfolio to be balanced such that real estate isn't overshadowing the private equity part of the business?
Yeah, thank you very much,
Peter Ndungu.
Thank you very much, Peter Ndungu, for that question. You know, this is something we're working on. As you explained, as at the beginning of last year, we had invested 7.5 billion in this business. Last year, the return of 1.5 billion, so we're down to 3 billion. So we are carrying it on 2 billion against an investment of 3 billion, so it's about 6 times. And we're expecting more capital back, but the path to exit is the path we are on, creating an investment grade asset, and ultimately to exit in that particular entity. So our core business really is not as an investment company, is not selling units, but units are an enabler to the creation of value in that particular portfolio company. So we are on that journey, and ultimately we see an exit, and that capital will then be redeployed back into the rest of the portfolio.
Okay, thank you, James. I think the other question is coming from Kate Wafula, and Kate is asking, at what point do we exit any particular business, and are there any exits that are in the pipeline?
Yes, the exit determination, Mr. Wafula, is based on looking forward. Do we have a likelihood of sustaining an IRR greater than 20%? Is there a significant value creation opportunity, and are we able to unlock that value creation opportunity? So, for example, when we made a decision to exit the bottlers, although there was still value creation opportunities, we are not well placed to do so. The shareholder we sold to was better placed to do so because they could consolidate the entire market. So each entity has a value creation plan, and once we get to a point where we are no longer the best owner of that particular asset, then a decision is made to exit. Right now, the number of assets we have is still significant scope for value creation, and that's what we're still the owners. Some of the assets we had earmarked for exit were affected by their business was affected by COVID-19, and so the exit was no longer ideal because we'd be selling at significantly lower valuations than we'd otherwise have sold. That's why we paused on the exit, and that's why it's important to build up the income portfolio so that you don't exit under pressure. You have to exit at the best possible value.
Okay. Thank you, James. The other question is coming from Benson Juguna, who's he's basically weighing whether it would make more sense to do a buyback instead of paying dividends, and his concern really is more about the organic growth, whether this would be more beneficial organic growth-wise for the share price.
So, you sort of weigh several things. Sort of the board weighs several things. The board's interest is to do what is in the best interest of the company, and we have taken several decisions that we think are in the best interest of the company, such as deleveraging the balance sheet, enhancing the marketable securities portfolio. Now, as to whether dividend or share buyback is better, it really depends on the quantum. Obviously, if we did not have this COVID-19 pandemic, the performance of the business would have been significantly different, and the cash flow streams would have been significantly different from what they are today. And so that question would have been very relevant in that context if we still had the discount as to whether what is an optimal way of distributing. However, because we are distributing within income and it is still below what we distributed in the previous year, the view was that it was better just to distribute it as a straight dividend.
Okay. So thank you, James. I think a question coming from Rakesh Gadani. He wants to understand exactly what development rights are and how that relates to TRDL and Centum, especially given the projects that are being handled by the two companies.
thank you, Rakesh. So the business model of Centum is they sell two products. They sell the units. So, for example, if you think of some units being sold in Palmarina, built units. We also sell development rights to other developers. So the way they come is that if you want to say develop 10,000 square meters, then buy rights to put up a 10,000 square meter building. What that right comes with is a lease, a long-term lease on the land, and that lease comes bundled with infrastructure. So you have right of access to water, power, roads, all infrastructure. Generally in our development is provided by the master developer. You also have a share of the common areas. So if you are to develop in a greenfield site, you then have bought the land, which is slightly bigger than what you buy here because you don't have a share of common areas. And then those infrastructure will then form part of the development costs. So in the case of, say, Two Rivers, because these have already been provided by the master developer, you as a developer, you just focus on your final build. So for example, when Centum bought development rights from TRBL last year to develop Loft, the reason they could do it quickly is because they were not spending time or money putting up infrastructure. They just focused on putting up the building. And then you pay for that component to the master developer. And the way we price it is that it's cheaper because you have economies of scale for you to buy the development rights as a developer, as opposed to you doing it yourself. Which is why, for example, Loft as a development or Riverbank as a development is cheaper than it would otherwise have been if it was developed outside. And that price advantage was then passed on to the end market. Which is why, for example, again to go back to an example like Loft, of the 32 units under development, 29 are sold. They are sold in a very difficult economic environment because the market is also very price sensitive. So we don't sell land, we sell development rights, and that's a model. So if Vipingo, for example, Vipingo Development has invested in a water desalination plant. They are working on a power facility so that you can just provide all investors with a plug and play solution. And that's why they're fairly sizable pipeline of sales for development rights in their site. So you're sort of a municipality and you're availing an integrated development. And what they have done with their own developments is to prove the concept across all those sites. So for example, in Palmarina, they have proven the business case of doing developments from as low as units that they're selling at $30,000 to as high as $1 million. And they're all profitable because the more the development rights on a plot are, the lower the cost. So that's a business model of Centum, and that's a business model of TRBL as well.
Okay, thank you, James. I think the other question is coming from Kefa. Maybe I'll take this. Is following up on the impairment query, has Centum made full impairment on Aklira Geothermal, or is it a partial provision? This is a partial provision, Kefa. It's not a full impairment. We've just decided to be reasonable in terms of the valuation, especially seeing all the activities are going on. So we still have a carrying value, and which we now believe is quite reasonable in the circumstance.
So Kefa, the valuation is based on the discussions we're having, because we're having a joint development discussion. And the idea is for the developer we're working with to convert the fixed component of the drilling cost into equity at a certain IRR. So you then sort of work backwards to then see what is the residual value and how does it compare to your carrying value. And we have the view that it would be prudent to reduce our carrying value to better align with where we're likely to land in this particular arrangement that Aklira is getting into.
Okay, thank you, James. The other question is from Agua Mazi. What is the outlook for the agriculture business, and what plans do we have to increase the business to an EBITDA of $2 million we stated earlier?
Yeah, the business is quite interesting. It's Greenblade is currently doing herbs, and we have one site. We're expanding to a second site this year, and on that site we want around 13 million shillings a month. So 13 million shillings a month times 12 is about 150 million shillings. So, and that's at PAT level, just on that one site. This year we're going to expand to 2 more sites. So there's a site we've identified because the crops, the products we produce are sensitive to the agronomy. And then also explore what we can do on our Vipingo site and also what we can do on our Palmarina site. So it's an important business because it has synergies with the existing assets that we have, because we have a lot more land in those locations that is not currently being utilized for either development, or those development rates have not yet been sold. So I actually feel, I'm the portfolio manager of that company, so it's a company I'm quite passionate about. I actually feel it's a company which you can scale up quite significantly, and it's a very significant cash generating entity.
Okay. So thank you, James. I think the next question is really from Daniel Nyaga and Eric Mokaya, similar questions. And the question is around what was in the press recently, which is the exit of City Lodge from Kenya, and what the likely impact on TRDL is.
Yeah, so City Lodge came to Kenya 7 years ago, and they acquired the assets of Fairview from the family of the Slapaks. And they're a listed company in South Africa, and they have not done well. They have had 2 sites in Kenya and 1 site in Tanzania. I think there have been timing issues. Just like you, I read in the press yesterday that we were aware that they wanted to exit from this market and go back to South Africa. There's no impact to TRDL because TRDL sold development rights to City Lodge. TRDL has no interest in the hotel. City Lodge has a title over their land, and they're running it as a going concern. And from what we could see, the asset they have in Two Rivers is one of the assets that is being sold alongside the Fairview Hotel in the city, in Upper Hill, and the one in Tanzania. So we are not, there's no impact.
Okay, okay. Thank you. I think a follow-up question from Eric Mokaya is around what the percentage of office space at Two Rivers that has been leased, and also basically in general what the leasing status is across at Two Rivers.
Okay, thank you. Actually, the interesting thing, Mokaya, is that we had expected office space leasing to come down. So on the tower that we occupy, South Tower, we are now at about
70%, 80%.
80%, so it's been increased. In the mall, it has actually sustained. It's about 80 as well. 80%. It's about 80%. That's the current leasing status. Obviously, the challenge TRLC had during the COVID pandemic, because of the lockdown and the reduced shopping hours, they gave certain short-term rental concessions to tenants, just to align their rental to the revenue, to the reduced revenue. And that affected the revenue in the short term. But the idea is to preserve the occupancy. So when the economy recovers, then you have the trading sort of capacity within the center. Okay. But actually, we are seeing something interesting where we are seeing increasing demand for office space. It is not something one would have expected under the circumstances. Yeah.
Thanks, James. I think the next question comes from Isaac Thande, and his question is, what is the latest on Amu Power? And considering the latest news about GPOW, who were the prospective equipment supplier, and also what is the impact on the P&L and the balance sheet?
So Amu Power, you will recall that in the year ended 2020, we fully impaired our investment in Amu Power. So although we own shares in Amu Power, the carrying cost is 0. So there can be no further loss arising from Amu Power. And if that project does come up, then there's potential upside. That matter is still at the High Court. There was a revocation of the EIA license by the NEMA Tribunal. Amu Power as an entity appealed at the High Court, and the matter is still in court.
Okay, thank you. The next question is from Joel Wandera, and his question is around how we are preparing for the next, looking forward into this current year and into next year, given that in Kenya we are going to go through elections and we still have COVID impacting on the economy. What's our outlook with regards to the business?
That's Wandera.
Yes, Joel Wandera.
Thank you, Joel. That's a good question. You know, when we were developing 4.0, we took a view that when we were looking at the indicators of the economy, that it was going to be a tough time which is the reason why we slowed down on the new investments and decided to sort of just show up the balance sheet and focus on repaying, reducing the debt, increasing the income portion of the balance sheet, so that we could build a more resilient entity. The entity we had in 2.0 and 3.0 was growth-oriented in a very buoyant market and a very buoyant environment. We did not anticipate at the time that COVID would come. We were not aware, but what we did has really helped the balance sheet withstand the shocks that we've gone through. Had we not taken those steps, would have gone through very challenging times. We had the debt we had, the finance costs we had, and if we had made new investments at the time, we'd probably be staring at significant impairment provisions today. So I think the board and we have taken the right decisions in terms of just building up the resilience in the balance sheet. And that informs even the decision to align the dividend payout to the cash income and not to distribute capital at this stage in time. Because as you've correctly pointed out, COVID-19 is not yet over. We don't know whether there will be further lockdowns, and we're also going to elections next year. So that's what we're doing. At the portfolio company levels, they are relatively strong, and we're sort of just working on accelerating the growth of those particular entities. I think last year, 2020, was a very thorough stress test on our business model. And the fact that a lot of our companies continue to sell, they continue to grow. Some distributed dividends to us, and we made a cash operating profit in an environment where traditionally the bulk of our income is from exits. I think just demonstrates the prudence of the decisions that were taken, the decision that was taken 3 years ago, to sort of focus on building a more resilient balance sheet that could withstand economic shock. So I think, and that's the path we've been on. We've spent 17 billion shillings in 2 years just to reduce the debt. We've come all the way from 16 to 3 billion shillings and that debt, remember, was built over 10 years, and we paid it down over 2 years. And one of those years we were in the middle of a pandemic, increased the yield portfolio. So we've sort of been working on consolidating our gains and sort of making the company a lot more resilient.
Okay, thank you, James. Just a follow-on question on real estate that had earlier been asked. This from Francis Mwangi. He's asking, please elaborate on the thinking behind real estate JVs while Centum is sitting on a large land bank.
Thank you, Francis. You see, Centum Real Estate is a portfolio company of Centum. They have their own land, but it's a market-oriented business. And they aim to provide the customer with a product where they are. Real estate is very location specific. If a customer wants to buy a unit in Kasarani, they're not going to buy it in Vipingo because we have land in Vipingo. They want it in Kasarani. So they're pursuing a capital light model where they don't want to spend money buying land, but they want to serve their customer at their point of need. So once you identify where the customer is, they then get into JVs with the landowners so that they don't buy land, but they get into a profit share arrangement. And the bulk of the money then comes from deposits, and whatever money they put in then goes to construction rather than paying for land. So Centum is not exclusively focusing on where we have land, but their focus is to be a market leader in the real estate business in the region. And that's our focus, so that then we can optimize the value of that entity as we prepare it for an eventual exit.
Okay. Thank you. I think the last question, at least the one we've answered most questions. The other one is coming back from Keith Ofula. He's asking which part of the business is giving us more trouble, or where are we having difficulties, and also on the converse side, where are we seeing high upside potential, and which area has high upside potential and is looking for investment.
Thank you, Keith. So where are our challenges? Where are we working? I think, as you've seen in the consolidated P&L, we had 2 companies that made significant losses. One is Longon, which is a listed company, and we made losses in 2019,
yes,
2020, and they made a loss, and because we own 60%, we consolidated 100% of it. The team is working hard. In fact, Wambua is the portfolio manager of that company, and we've seen significant improvement. The second one is TRDL. We own 15%, but we consolidate 100%, and that's largely a capital structure issue. So we are resolving it. From an upside perspective, we see significant upside across the portfolio. If you look at, I'll just take a few examples. If you look at Dividend Bank, for example, it's now making about 50 million shillings a month. So if they keep at that trend rate, it's about 600 million shillings. And there's room for significant growth. At a multiple of about 7 to 8 times, I think you can have a reasonable exit down the road at a sizable uplift. If you look at Centum, we are having it has taken us time, but it's turning out to be a very good investment. We had invested 7.5 billion. We got 4.5 this year. They have a pipeline that is likely to distribute another 4.5 over the next 36 months. They have development rights of 2 billion that are in the process. The target distribution is 50% of that, which is $1 billion, so about another 5.5. So in another maybe 24 months, we'll have got all our capital back from that business, and what we'll be sitting on is profit. And that company has significant upside and significant exit potential. So we have every company that is on our balance sheet, there's a value creation plan. And we've had it for a long time, but it was interrupted by an unprecedented economic shock. So, and that is really going to be driven by profit growth and opportunities for transformation. You're also seeing a lot of interesting opportunities in the market now, where you don't have to deploy a lot of capital, but where you can create significant upside just by helping them through the transformation process. So those are where we see opportunities.
Okay, I think this the next question is from Oswald Kapotsa, and he says, I confirm my condolences to the Kirubi family and Centum PLC for the recent passing of Dr. Chris Kirubi. May his soul rest in peace. So his question is really, who will now take over control of his shareholding in Centum, and how will this impact the company's strategic direction going forward?
Thank you, Oswald, and thank you for your condolences. Chris was a good friend to all of us, and so we miss him. Before Chris passed away, he had nominated Andrew Msangi, who is a member of his family, and not just a member of his family, he's a very experienced professional. He's an advocate of more than 25 years standing. He chairs the board of Gen Africa, which is one of probably the second largest asset management company. And he had nominated him as his alternate on the board. The board of directors yesterday appointed him in his own capacity to fill the casual vacancy that has arisen following the death of Chris Kirubi. There will be no real change in the business, because the business is guided by a strategic plan. We are not aware of any intentions by his family to change their shareholding structure in the business. Chris was not involved in the management of the business, so there's really no change other than us missing Chris and missing his contribution on the board.
Okay. Thank you, James. I think we've answered actually all the questions that have come in. I don't know that there are any additional questions. Please feel free to put that on the question board. But I think we've answered a lot of the questions that have come in, and quite wide-ranging, covering the whole spectrum of the business. I don't know that, James, you have any closing remarks?
No, mine is to thank all of you who've joined us this morning for your interest in the business, for your illuminating questions, and to say that we're available to answer your questions. This presentation will be posted, and if you need any further investor call with us, we are just a step away. We are continue to work hard to, we are very concerned about the share price, just as you're all concerned. We are also shareholders in the business. But John Maxwell says you focus on your circle of influence, and our circle of influence really is making the company better under the circumstances. And it's not the circumstances that count, it's your reaction that counts. And so we've taken the circumstances as they are and sort of trying to make the best possible decisions under the present circumstances. We are making good progress in a lot of the businesses. The interesting thing with our business, unlike an FMCG where you have short cycle times from production to sale, say you're selling beer or soda. Our business, we sell companies, we build and sell companies, and this take time. And sometimes, you know, just ask you for patience. We've made good progress with Centum, which will lead to us having a more balanced portfolio in the not too distant future. And a lot of the portfolio companies are showing good promise. And I think once the market turns, there's significant upside potential in the share of Centum. You know, it's fairly stable board, stable shareholding base, stable management team. And we encourage you to reach out to us should you have any suggestions or any additional questions, either myself or my colleague Wambua.
Okay. Thank you, James, and would like to thank all the participants who joined us this early morning for our investor briefing. We want to thank you for all the questions that you've posed to us, and we hope that we've done as much clarification as possible. So we are available to take any queries that you have. The investor relations team and myself will be available throughout to answer your queries. Thank you very much. Keep safe and God bless. Thank you.